Is tech turning around? Hi, everyone. Welcome to the Market House. I'm Maggie Lake, and today I'm talking markets with Jim Welsh, founder of Macro Tides Research. Hi, Jim. It's your first time with us, so a very warm welcome.
Well, thank you. It's great to join you. It's great to be in the house.
Yeah, in the house. That's right. Hey, everybody who's joining in the chat. If you're trying to join on YouTube and you're having a problem in the chat, that's because I think there's a YouTube issue. It's a little funky. It wasn't even letting me comment before. But persevere. Maybe it'll pop back. But if you're on Substack, and even more reason YouTubers should jump over to our Substack, feel free to put some questions in and we'll do as many as we can as always, but it's fantastic to see you. So Jim, the big event, drum roll please, is going to be happening any moment now. And that is Nvidia reporting quarterly earnings. Ahead of that, we saw US stocks bounce. The NASDAQ, the biggest gainer, it was up over 1% last I checked. And, but it, gains across the board. Interestingly, gold, silver and platinum, even more so. Metals were up. Crypto's finally getting a bounce. Bitcoin above 68,000 and ETH and Solana up 11 and 13% respectively. So looks like people are sort of covering their bets. I don't know, maybe does it seem like a shift in attitude or is it more of a risk on mood today? And you think it's sustainable?
Well, I think the main thing is that some of the areas that have been really beat up that you just cited, software, for instance, is down 35% from its high last September. And the magnitude of the decline, Maggie, is comparable to what happened during the financial crisis in that sector, as well as the unwinding of the dot-com bubble. So in Monday's weekly technical review, my take was that stuff had gotten so stretched to the downside, it was due to get a bounce. Plus, if you look at a chart of IGV, you can see going back the last 10 years or so, it got down to an important price level. So I think we have to take this as a bounce to begin with, and we'll see what kind of legs it has. I think some of the concerns that people have about AI replacing some of the business of these companies, that's not going away because they bounced today. I think that's going to linger. But in the near term, they got down to some valuations that I think some people found attractive, and they're down a lot. So I think we get a bounce. Nvidia, obviously, when it comes out with its earnings, I think the numbers are going to be terrific. It'll be the guidance that they provide that'll probably be reflected in tomorrow morning's trade.
Yeah, I feel like just when everyone gets super bearish, and there is no shortage of bearish commentary on the AI spend and the sort of foolish CapEx arms race, spend now, ask questions later.
Yep.
There's just a huge amount of commentary swirling about that. Does it feel like they're in this situation where it has to be extraordinary? How high is the bar? I guess what I'm asking. Like, do they really have to say something incredible? Is everyone geared up to be disappointed, or have we kind of moved past that? And maybe there's some room for the CEO to say something that does sort of ignite another mini rally here.
I think the comments are going to be positive because Jensen is always positive. And so I can't imagine he's not going to be telling a good story as he always does. I think the disconnect here is the AI hyperscalers are going to spend an enormous amount of money this year and next year. The rate of change is slowing. I think it was 30-some% last year. It's going to slow a little bit to, below 20% this year. So to me, you have to divorce the spending from how the stocks are going to trade. And I think one of the tells we saw, Maggie, over the last few weeks is a number of companies came out and said, yeah, we're going to be spending this much more. And the stocks didn't rally like crazy, which is what they normally have done the last 2 years. And in fact, they sold off. So I think there's a bifurcation between the economic impact on the economy from all this spending and how the stock market is going to judge when are we going to see a realistic rate of return on all this spending. And it's like anything, during the internet, everything that was promised in 1999 and 2000, the internet, I think came true, and even more so. But there was this big valley. And I think there's going to be a valley between, and we're seeing the first hints of it in terms of how the stock market's responding to these companies. And then it's not changing their spending and their impact on the economy. So to me, that's what I think is going to continue to play out this year and maybe even more so next year.
Yeah. And AI can, as we've been saying, the technology can continue to wow or
Right.
scare us, which is also a big debate. But that
Yeah.
doesn't mean that every company involved is going to survive. That doesn't mean that these valuations make sense. I think it's worth, you mentioned, the AI jitters, and we've seen that, right? What is the impact
Yeah.
on the overall economy? What about sectors just wiping out, just steamrolling through sectors? But I was surprised because we've been talking about a lot of that angst on a day to day. And when I looked at S&P and Nasdaq, right there, yeah, they're down from the broader indices, down from where they were early, in midway
Right.
through the fall, but they're not. They're certainly up from a year ago, double digits.
Yeah.
Even 6 months, they're up. How are you feeling overall about valuations around U.S. equities?
Well, they're ridiculous. And a lot of no, they just are. I mean, if you look at any chart, and there's probably 5 different ways to measure valuation, everyone is pressed up against the ceiling. But the point I make is valuation isn't a reason to sell. And the
Mm,
market doesn't go down unless there is a reason to sell. And if you put it into context, we are in a long only business. I mean, institutions buy for 3 to 5 years. Financial advisors tell their clients, hey, we're buying for the long term. We're going to ignore the dips and so forth. So in order to get people to pull back from that behavior, something has to threaten them. Now, the most common and most potent reason has been recession. So to me, you always have to ask the question, what is the likelihood of recession in the next 6 to 12 months? I think it's really, really low. So
mm,
until we see a good reason to sell materialize, valuations can stay high and as we've seen, press higher. But what it does mean, Maggie, is when a good reason to sell materializes, stocks get hammered. I mean, the average bear market in the S&P going back, I don't know, decades and decades, I think it's like 36%. But you look at the declines that have taken place when the market was overvalued, leading into those recessionary periods, it's a much deeper pullback.
mm.
So it's a risk out there, but it doesn't get triggered until we see material reasons to sell show up. And I
Yeah.
think that's been we understand buying pressure, but the absence of selling pressure is just as important. If the market doesn't have to overcome selling, it can work its way higher. There may be concerns. People are worried about stuff. They're always worried about something. But until they're motivated to sell, the market can either tread sideways or press higher. And I
Yeah.
think that's the kind of environment we have been in. And, my take in 2022 was we weren't going into a recession for a lot of different reasons. A lot of people were really worried about that.
Mm.
So, you have to be, I guess, somewhat confident that you're looking at the right things to determine whether or not we're going into a recession. And
Yeah.
again, my take right now is I think we're okay. I mean, we're going to look at a slide in a little bit that
Yeah.
shows some of the support that is underneath the U.S. economy over this year. It's pretty significant.
Yeah. First of all, I think it's such a great way to look at it because I feel like in a lot of people's guts, they worry that it's overvalued, but you're right. You sort of need that trigger, and that reason to sell. And we've talked about a lot. And those who know Mike Green, the passive flows are strong. So you've got
Yes.
to swing that around.
Yeah.
So let's jump into some of these slides.
Just interject one thing, okay, to
Yeah,
kind of finish up what we were talking about.
sure.
So what we've seen is this enormous spending by the hyperscalers. And initially, it was all funded from cash flow.
Mm,
And now what we're seeing is that the spending has reached a level that it's absorbing a greater and greater share of cash flow. Some of the companies are resorting to debt.
mm,
Meta has resorted to off-balance sheet debt. And so that cash flow not only funded the AI spending, but it also funded, especially over the last 5-10 years, an enormous amount of stock buybacks. So as that cash flow starts to dwindle, one of the big supports under the market, because these stocks have huge capitalization within the S&P, that prop is shrinking and it will continue to get smaller. So to me, that's the other aspect of what is going to play out over the next 12 to 18 months is as that spending is funded by debt, I think the cash flows then start to be deflected away from buybacks to the
mm.
extent that we've seen them. Well, that's, I think I said, if you look at charts of buybacks and how much shrinkage there has taken place, in terms of capitalization for a lot of these companies. It's really kept it in line. So I think that's a big thing that's lurking in the background. But I think it'll, as we go forward the next 12, 18 months, it's going to make a difference in terms of how the market responds to buybacks, because it also inspired confidence. The buyback window is about to open up again. Yeah, man, let's jump on that sale. So, there's a ripple effect in terms of other investors, kind of betting on that, helping out. And that's going to get reduced.
You're taking a massive buyer out of the market, right? So
yeah, exactly. Now it's not going to happen overnight, but it is already happening, and I think it's going to increase in the coming months and year.
Yeah, that's a fantastic point. So talk to us a little bit about the supports so that's one big support. Talk to us about some of the other supports for equities and whether you see them continuing, or are we starting to see fraying? What are the implications about
in terms of Brian? I don't know if he could grab, I think it was chart number 8.
GDP? Is it GDP?
Yeah, the GDP
multiple
chart.
Supports? Yeah.
So, what we see is Besson said a couple of years ago, we're going to shrink the deficit from 6 to 3%. Well, guess what? That hasn't happened. I think the deficit is going to be 5.8 this year. But if you think about it, 6% deficit is huge. And yet we're only getting like 2%, 2.2% of GDP growth. So that spigot isn't getting turned off. AI spending in total is about 1.6, 1.7% of GDP. The top 10% do 50% of the consumer spending. Well, as long as the markets stay healthy, that's not going away. The one big beautiful bill is expected to add about 0.7%, both in terms of tax refunds this year, which are going to be I think they're going to be up about 20% from last year, and the tax cuts. Their net pay is better. And finally, unemployment rate around 4.3, that's up from 3.4 a couple of years ago, Maggie. But if you go back 50, 60 years, 4.3 on a chart looks, wow, that's in the lower quadrant. So all these things are positive for the economy. And I just don't see where they're going to change in a meaningful way. Now, could there be an exogenous event? Of course there can be. But knowing what we know, I think it's fair to say the economy should continue to chug along at 2% or so. And, that does not smack of a recession.
No, it doesn't. But how sort of leveraged are we to the stock market? Because when they start to fall out of bed, Washington gets very nervous. That feels a little different than when it used to be. I mean, we can talk. You have a chart number 2, the wealth effect. We sort of know this, right? We know that there's a wealth effect, but how reliant are we on that now?
Well, it's the top 10% represent 50% of consumer spending. So people talk about the K-shaped economy, and what's happening is the bottom 50% of people have been struggling for a while. That's one of the reasons why President Trump got reelected, is because a lot of people, I think naively, thought, oh my goodness, in 2018, I was in a much better place and he'll make it go back there. No, that's never going to happen. And so the rents are up 40%. Well, if you don't own a house and your rent's up 40%, you're fighting a gun. You're spending more money on utilities and food, car insurance. I mean, so those are the squeeze that's happening on the bottom 50. So that top 10% and what they're doing is really the main reason why the economy continues to chug along the way it has, and why it had, maybe if you will, consumer spending has surprised people. They've got the money. They feel really good because asset values are up, and they're taking trips, everything else. So the flip side here, and I'm just going to digress for 1 second. In 2010, Ben Bernanke, when he was chairman of the Fed, he introduced QE, continuing doing QE, because they wanted to boost asset values, because they know there's a multiplier effect. As asset values go up, people spend, every dollar gain in the stock market, people spend maybe 3 or 4 cents of that. And so that in housing prices, that was an intended goal of monetary policy. That's never happened before. All right. And so they've succeeded almost too well in terms of making this happen. But now we have this dependence on asset values to sustain spending, Maggie. So if and when we see a meaningful pullback in housing values, I think housing values, and I've discussed this in my letter, are going to drop 10 to 20% in coming years, just because the affordability issue is such a huge problem. The stock market, I think, dropped 30 to 50%. I mean, you say, oh my goodness. Well, I think somewhere over the next 3 to 5 years, the economy will falter. We'll see that kind of decline. So the difference is, at this point in time, as those folks who have been spending pull back because asset values start to suffer, well, that's going to make a recession deeper and last longer. And so to me, that's the dynamic that's out there in the future. We're not there yet, obviously, but I think one has to be cognizant of the dependence on asset values for driving demand.
Yeah, two things jump out at me when you talk about that. One is when you see housing prices drop like that, it welcome news to a generation who has been left out. But that would be if it's orderly. If they crash, then you're sort of wiping out equity
Yes.
from people, and there's a difference there. And you want to solve the housing crisis. And Jared was talking about this when we were in Nashville, Jared Dillian, and we'll go over some of that next time he's on. But you want to solve that problem, but not in this way. You don't. We saw what happened in the ripple effect of the economy, so that's very important if you see a big decline like that. The second thing I wonder about, if we could pull up chart 4, household allocation to stocks. It's interesting what you said, because it seems that the solution is, let's get more people in the stock market. We see the Trump in the State of the Union last night talking about these retirement accounts for everyday people. And there are a lot of folks on Substack and on X saying, like, wait a minute, this is not a good idea. I don't think this is a good idea. I wonder, based now on the fact that we are more people exposed to the stock market, is that a concern that if we start to see this is no longer a situation where people in the 10% who have the cushion to perhaps get through a drawdown, if you've got other people who are not in that situation, I would think that negative wealth effect is amplified. If I start to see money I barely have disappear, that cannot be good for the economy.
Well, again, that's exactly the point, is that, and if you look at that chart, you can see from the peak in 2000, which is kind of that second shaded area from the right, and you can see what happened is the market went down, people pulled back their allocation to the market. Mm-hmm. Same thing happened, obviously, in 2007 to 2009 or 10. That big swing down, goes from the peak, I believe, in 1968. And the trough down into 1982. Mm-hmm. So again, people react to the stock market, and as they pull back out of the market, they're also going to be cutting back on spending. And so if we go into recession, the unemployment rate is going to tick higher. And so the bottom 50 who are already struggling, they're going to be probably more impacted, as we slow down in a meaningful way or go into a recession. So there's nowhere to hide then. Mm. And so the Fed will employ the same tools that they have, cut rates, QE, and so forth. But what you can see is it takes a while for people. Once burned, you kind of are, takes more to convince you. And so again, I think, is it great to have people invest in the stock market, in terms of what President Trump is projecting? Yes. I think the timing is like, oh my God, they couldn't pick the worst time.
Exactly. Yeah, at the bottom, not at the top.
It's like, okay, you gave me 1,000 and now it's worth 550. Thank you for nothing.
Which, by the way, we know from the .com period, we lost a generation of investors who were so badly hurt when it sort of spread out to more people. Although I just want to mention that obviously retail's been killing it. And so I think this is the people completely out of the market, not you, fantastic, which some of you are in the community, fantastic, self-directed, let's call you that, who have been just absolutely killing it. Let's talk a little bit about the dollar. So we have a chart, I think 12 is long-term. What do you see happening with the dollar? Actually, let's do 11. Let's do 11 first. Yeah, because I love this. You were like, wait a minute. Anytime you see something on a magazine cover.
It basically, things show up on a magazine cover after the trend has been in place for an extended period of time. It's like driving your car, looking through the rearview mirror. Hey, this has been great. This has been okay. Now magazine cover shows up. And it doesn't matter what market is. So Barron's last weekend had this story. Well, this would have been great if it was like in January of last year when the dollar was 110 as opposed to 98, you know. And so this is a warning sign from my perspective that the downward trend is probably nearing an end. Now, it doesn't mean the dollar is going to go to the moon, but a significant rally is poised because this cover reflects positioning. You know, people turn negative against something. What do? They sell it. And then the aggressive types will go short. And we have seen a pickup in shorts in the dollar or being long other currencies. So to me, the message here is not just specifically about the dollar, but anytime you see a cover on a magazine, you have to take a step back and say, whoa, there's a yellow light flashing here. And it's time to pay more attention as to whether or not the trend that has been in place, that they're expecting to continue to go, is ready to reverse. And so
and by the way, we still sometimes get paper in my house. They have it on there too. Big black cover, like doom.
Oh yeah. We don't want to have any light showing there, man. We want it doom and gloom.
Yeah. And it's not saying like this says the US currency has lost its dominance. It's not a debate. It's done. You know, this is the debasement trade. But now are you thinking, so we have a chart that's 12. Are you thinking that this is a short-term situation though? Like maybe longer term, the dollar is in decline, but short-term, we might get a bounce higher given the positioning.
Yes. And from the standpoint of, you know, when I think we're at inflection points. So when the dollar was at 114 in September of 22, you know, to me, it was set up to decline as the chart notes under 105. And I'm just looking at the chart analysis and saying, okay, where's the first realistic support area? In the same way last January at 110, I was looking at the dollar had declined about 15 points from 114 to 99 and change. Well, what's 15 from 110? 95. And so that was my take, is that we were going to have a decline below 100 and maybe get down to 95. What was the low in January of this year? 95.56. So the fact that those two declines are relatively almost to the penny equal suggests, okay, they're related to each other. And that's why you have A, B, C on the chart. I think the dollar has completed an intermediate correction from that high at 114 that took place in September of 22. So we're poised for, I think, a rally. We've been building a base. The dollar is that blue horizontal line you can see is at about 100.39. That was an intraday high. There was a high, I think, at 100.25. So confirmation of this basing bottoming phase will be achieved when the dollar, if and when the dollar closes above that blue line. What does it project to? Well, I think 105, 106. Is it possible that blue downsloping line that we could attack that? Yeah, but I take this stuff one step at a time, Maggie. And so the way it rallies, if it does, the pattern that emerges as it rallies kind of reveals its staying power. If it's a simple 3-wave up, down, up, well, that's not going to have a lot of staying power. But if it's a 5-wave move, then that means even after a pullback, there'll be another push up. So chart analysis and pattern analysis is a big component. And, you know, I look at it in terms of GDP's growing better than expected. Maybe we'll talk about inflation a little bit. I think that's going to tick higher in coming months. Is the Fed going to be cutting rates in that environment? You had Goolsbee, who's been one of the biggest, doves for a long time. Well, he's in the camp, hey, I'm not sure I'm ready to cut rates with inflation where it is. Even Waller, who's had
Waller just said that, right?
Okay. These guys are acknowledging that, wait a second, the economy is in decent shape. Inflation is comfortably above 2% and isn't showing any signs of working its way down. And in fact, I think in the next few months, it's going to push a little higher. So there's no real reason. And the idea of the restrictive rate, level of restrictive, the neutral rate. Now, if you listen, nobody knows where the neutral rate is. All right. It's a theoretical concept that Powell has said we only know it with the benefit of hindsight. How did the economy behave? How strong was it? Kind of tells us whether the neutral rate was too tight or too easy. That was the justification to lower the funds rate 175 basis points. because the neutral rate, when we're at 5 3/8, if you think it's at 3%, that's a big gap. So they've narrowed that significantly. And so that reason to ease is pretty much out the window. So unless we see a decided period of weakness, renewed weakness in the labor market, there's no reason to cut. And people talk about the revisions. They were big. But the point I've made, Maggie, is those jobs never existed. They were an accounting notation at the Labor Department. And we then look and say, well, the economy was growing at 2.5% when those jobs even weren't there. So to say, oh my God, the sky's falling because they revised a bunch of jobs away makes no sense to me. So those
by the way, no, it's a great point. But you have other people, this is where it's kind of, first of all, we know President Trump wants lower rates. We know that there's going to be enormous pressure on wars. And then there are people who say, if you look at trueflation, if you look at other measures, that you get a different picture. And these concerns about AI rapidly starting to take jobs, maybe that lays the groundwork. That inflation question is so tough because there's so much division. I just want to say there's a flash just to what you were talking about, Jim. Salesforce commits $50 billion for new buybacks as revenue guidance falls short.
Wow. Yeah,
so
they're trying to prop up the stock.
But as you say, as these cap spending now, Salesforce is not necessarily in that boat. But as we see their capital dwindling, they're not going to be able to do that. So maybe they're still doing it, but if that starts to go away, and if people sniff out that may not be enough to prop up the stock.
You might get a knee-jerk pop in Salesforce, but if people perceive, hey, 12 months from now, 18 months from now, we still think your core business is going to be under pressure. They're not going to be like, oh, let's buy it for the long term. We'll buy it for a trade on this piece of news.
Yeah. Yeah. And there are, and that's a good point to make too. There are people who are very nimble, who are able to get in and out. But if you are coming from an investment lens, right? I'm spending some time with those people in the morning this week over at Ninja Trader Live. And they're capturing that. That's great. But if you're an investor, you want to, of course, as we always say, understand your time frame. Want to ask you about gold. So this is if you think the dollar is going to get at least a short-term pop, does that mean that we see a pullback in gold or not necessarily this time around?
I think so. Again, when did gold bottom? In September of 2022 at 1616. The dollar was topping at 114 within a week of that happening. So as the dollar has been working its way lower, we've seen gold make this big move up. From the low in December of 2015, gold was down to, I think, 1,046. It rallied over 2,000, pulled back to the 1616 number I just cited. I think the high that we saw, in the last month or so, was basically the end of wave 3 from the low. What that implies is we get a wave 4 pullback that can either be a whole bunch of sideways that just wears everybody out, or a more protracted decline. At this point in time, I don't think there's any way to know. What we see is from 55.95 down to 44.07. That was the first part of what I think was wave 4, Maggie. We're in this rebound to retrace, it was about a $1,200 decline. We're getting this rebound, retracing that. I think you could see gold push up towards the 53.40, which is a 786 retracement. But my take is once the current rally is over, I think gold will drop below 46.56. And there is a chance it could drop below 44.07. There's just no way of knowing if it's going to be an A down, B up, and a C that takes you to like 4,200, or we're going to go sideways and chop. At a minimum, I think gold is setting up for a pullback below 46.56. Once this wave 4 is over, gold will then rally to a higher level in wave 5. How high that is, could it be 6,000, 8,000? I have no idea. You cross that bridge when you get there.
Yeah. And I've heard some I've been spending a lot of time talking about gold, and I'll share that with everybody in my Substack. But yeah, there are a lot of dynamics behind that. But again, these are short-term moves in longer-term trends, and you have to be
Yes.
really conscious of them. And by the way, if you've been on the sidelines or looking to increase your exposure, that might provide a very nice opportunity to do that. You were talking about those sort of magazine covers. I also, I can't remember if it was yesterday, this morning. The days are blurring together. I think it was this morning. Was sort of getting out to yet again scrape some more snow off my car really early in the morning, and on a morning talk show, mainstream, not a business show, like sort of here's your weather, here's your cooking segment. There was this segment about what to do with your gold jewelry, how to sell it, and I thought that's interesting. And it's sort of like when your taxi driver's asking you about Nvidia, like ding, ding, ding. Maybe this is a little bit of a sign that things are a little bit frothy right now.
They are, and again, that represents supply. As more people do that, again, I'm just going by the sentiment when the gold hit. You had a parabolic move in both gold and silver. Those are terminal moves. All right. Now, I'm of the mind that isn't all gold has in it, longer term. Right. But it suggests that the unwinding of all that bullish sentiment is going to take time and price erosion. And the pattern suggests, as I said before, you might have a little bit more strength near term. But if I'm right about the dollar getting above that 100.39, I can't imagine that that's not going to put downward pressure on gold and silver.
And when we talk time frame, when you're looking at that, are we talking about weeks, months? What kind of, when you're looking at that?
More months.
Months.
I mean, think about it. The dollar just went through a correction from September of 22 to January of 25 or 26, pardon me. So that's 3.33 years. So this rebound should take 6 to 9 months, I would think, at a minimum. And that also would be the flip side in terms of gold. Going through a correction that could last 6 to 9 months.
Right, which, as you said, the correction could be sideways. Doesn't have to mean that it's a substantial pullback. It could just mean sort of building a base.
In other words, the pullback low of 44.07, that might be as deep as it gets. And you do a triangle where you go down, up, down, and you wear everybody out. But at the end of that triangle, sentiment is much more cautious about gold. And people are a little more downbeat. Geez, I've been sitting with it and it hasn't done anything.
Because everybody wants everything to 10x every day, or in this kind of instant gratification.
Yes. I want it now.
Oh my gosh, Jim, it was such a pleasure to have you on. We're out of time, but thank you so much for stopping by the Market House. We appreciate it.
Well, thank you very much. Appreciate the invite. Hopefully next time we'll talk about the bond market, which
I know we didn't even get to it today. And it's super important. We will do that, especially we've got a Fed meeting coming up in March. Jim was nice enough not to rub it in because he is in warm San Diego. Right? San Diego?
Yeah, just north of San Diego. And some people might be familiar with La Costa, which is north of San Diego. I'm just east of that. And the temperature's above, and
don't even go there.
But I told you, I grew up in the Midwest. I appreciate what February going into March means. You got all that great snow, and then it's going to melt, and it's just a fun mess to deal with. So
it is a mess to
deal
deal
with. Thank you again, Maggie. I really enjoyed this.
At least we won't have drought warnings. And we've got some people in our community who are sitting in some pretty sunny, nice places too. So everyone's been super kind about keeping their thoughts with us as we dig out. But it was lovely to have you. We are going to drop Jim's information, where to find him, and you can email him he's got some charts we didn't even get to. You can email him for the charts. We'll put all that information in the chat and in the Substack. So thanks everybody. Have a wonderful second half of your week. We will see you back with Dale on Friday. So in the meantime, take care and good luck out there.